Hello, and welcome to the first edition of Smith and Sheridan on Biotech, a new podcast dedicated to the science and business of biotechnology, hosted by myself, Cormac Sheridan, and Andy Smith. Hello, Andy.
Hi.
It's another September. For some, that means a resumption of studies after the summer break, or indeed a whole new beginning, be it at school or at university. For seasoned biotechnology executives, it means getting back out on the road. Although some companies can and do raise funding over the summer months, for most, the arrival of autumn kickstarts the fundraising season in earnest. As Andy has noted, maybe you might make this point, Andy, about academic forecasting, speaking to the two trends. You've identified them as being cyclical and seasonal.
Yeah, thanks, Cormac. I actually used to teach business forecasting at a business school, and there are other elements to a forecast, but two of the most common that the academics talk about are seasonal, as you talked about, and cyclical. Cyclical factors last longer than a year, and we're relevant to biotech fundraising. You know, we have peaks, we have troughs, we have bubble periods, and we have what I've called wilderness periods, which incidentally we're in at the moment. And then we have seasonal aspects, particularly on fundraising. And we're in, again, one of those at the moment. And as you suggested, Cormac, we're in that period where we're about to, or CEOs and company management's about to go on the road or are already on the road in order to raise money. And there are a number of those parts or a number of those fundraising windows in the year. We've just been past one. So virtually everything stops for the summer, for August. And that's so much a self-imposed quiet period, but everyone needs a holiday, right? Everyone needs a vacation. So that's that aspect of why it stops. There is a mad rush on the run up to August so that companies can either get out to investors to get their faces seen for the fundraising that comes to institutional investors after August, or they might try and raise funds, just before we break for August. There are other times when this rush to fundraising happens as well. Prior to the JP Morgan conference in early January, companies will try and get out to investors in November, December, either to raise funds before the year end, because for retail investors and non-institutional investors, there's tax loss selling, so they want to get their names and faces and their stories out there before the end to remind them that they still exist, right? And please don't sell my shares. That aspect before the year end, and that's to get their stories straight, either to raise funds prior to the year end and tax loss selling, or actually to get their stories straight for everyone to meet, to encourage people to meet them at the JP Morgan and other satellite conferences in January.
But could you not say as well, though, that, every biotechnology CEO, it's just almost a kind of a credo, they're never not raising cash. So even if they're not actually signing deals in the month of August, and some do, but even those that aren't necessarily formally signing deals, the conversations with potential investors surely are ongoing. And to that extent, how much of it can you really say is seasonal or cyclical? Well, cyclical, definitely. Seasonal, I'm less sure about. Granted, there are rhythms to the year, but people always look to top up their coffers, especially those that are running on or close to running on empty. It's an ongoing conversation with the investment community, isn't it?
Yeah, it is. But also the point I made earlier that biotech CEOs need a holiday as well, right? They need downtime. They go on holiday, hopefully like the rest of us in August. They have holidays with their families around holiday time in the US. So you'd expect much less activity, but you're absolutely right, Cormac. When your broker, and I'm talking to institutional investors here, when one of your brokers rings up and says, we've got a non-deal roadshow, as an institutional investor, as I used to be, you think, I'm relaxed. I could just hear the story and no one's going to be pestering about raising funds. There is no such thing as a no-deal roadshow. It's not a no-deal roadshow. It's not a deal roadshow when they see you. But the next day, week or month is going to be a deal roadshow. So yes, biotech doesn't get done without money, and that money comes from investors.
You've been talking about this being a wilderness period. There's still cash being raised, so it's relatively speaking is a wilderness period. How would you? And you could argue as well that we've reverted to historic norms after the sort of COVID-19 associated investment bubble, which arguably pushed biotech stocks to values well beyond their intrinsic worth. So is this actually a wilderness period, or is it a reversion to the historic norms of the industry?
Well, I mean, when we talk about historic norms, and institutional investors will know that the long-term trend, and that's hundreds of years, the long-term trend of stock prices is up. Okay, but within those, within a shorter time frame that us mortals will observe, there are periods where biotech goes up a lot, and there are periods where biotech goes down a lot. You just mentioned one in the pandemic, or just during the pandemic, early stages of the pandemic. If you're a biotech company and you'd repurposed your molecule that didn't really address a respiratory viral infection before into something that you think could work, you could trip over yourself, but the investors offering you money to develop that drug. And then, of course, now we're suffering that particular aftermath when most of those drugs didn't work in COVID-19, and they've got to go back to, they wasted a lot of time in developing drugs for COVID-19 that weren't going to work, and they've got to go back to their business as usual. That, I think, relates to your reversion to the norm aspect. But looking back over recent history, we can see, and I managed the fund through, I mean, I joined fund management in 2000 just to be there for the sell-off in 2001. And we got to that period in 2000 with the Human Genome Project and Tony Blair and President Clinton standing in the White House lawn saying, it's sorted, right? We have the human genome sequence, and biotech's going to do everything from here on in. Stock prices went up, of course, in anticipation of all those drugs development. And to be fair, a lot of them were as a result of those discoveries, but not all of them. Yeah, and it's a sad fact of life that most drugs fail in development. As an investor, you will invest in many companies, more companies that fail than succeed. And it's not just a numbers game. You have to put some diligence in there to try and recognize those. But yeah, there are periods where that diligence is less important or more lax than it isn't. So in a bubble period, as I mentioned, in fact, the last bubble period that finished in August 2021, before that period, you could be a preclinical biotech company with no plans to file an IND, let alone run a clinical trial. And you could get onto the market and raise reasonable money at $1 billion or multiple valuation. And we are living down that aspect now. I mean, only this week, there were the issue of Bluebird or 270 Biotech, which was a Bluebird split off, whose CEO has finally resigned, and they've cut jobs, and because their promises that were early on have not been lived up to. And that's an aspect that results in the cycle. So we have a period where there's a hiatus of biotech can cure everything. And we have the aftermath period of where biotech, hasn't done what we hoped it would be. In between those two periods, the important question is, how long does that wilderness period last? 2001 to around 2008, 2009 is a long time. But although we can recognize in retrospect when a peak was and when a sell-off was, knowing when it starts up back again is a bit different. Was it 2008 or was it 2009? But when it goes, that bit is obvious, but the period of the wilderness is not a bit obvious.
Because a company, it's impossible to locate yourself in real time in any kind of an investment cycle, regardless of what sector you're in. But also, just to come back to the idea of this wilderness period, how do you define a wilderness period? I mean, there are still billions of dollars going into this industry globally. Some very big deals are still going down. There's some IPOs have been filed this week for fairly large amounts of cash. What was it? I don't even have them in front of me here now, but Actio Biosciences raising some VC money, Rome Therapeutics raising cash, Lib Therapeutics doing a very big deal in Asia with Haston Biopharmaceutical Company, 325 million up front for a PCSK9 inhibitor. There's also some IPOs going down, Turnstone Biologics. Also, there's another big one coming through with Apogee Therapeutics. So there's still cash flowing. How do you characterize a wilderness period in contrast with a bubble period? What are the key differences?
Well, as you've been describing, Cormac, there is one factor that I've just thought about that characterizes a bubble period from a wilderness period. And that is, as we're seeing at the moment, I anticipate those companies that are completing their IPOs, whether it's NASDAQ or Europe, if their existing VCs don't have to fork out to what they would say is defending their investment. So they have to take a big chunk of that fundraising just to get it away, just to give the company enough money to do what they said. So in bubble periods, they don't. They wait for the 6-month exclusivity period to finish, and then they sell their shares in the market, and then they go on to fund the next companies. Right about now, I imagine, and characterized by other wilderness periods, there are fundraising for public companies that are highly dilutive. And as a fund manager, I can remember ringing up CEOs of companies I invested in complaining about, why are you raising at this? Because your share price went down 30% on the basis of that fundraising. And even more when your brokers who've got warrants and shares for free just ditch those into the market. So there are those unpleasant aspects of being in a wilderness period. It is difficult to raise money. The appetite from the generalist retail investor, the generalist institutional investor is not there, because they could invest in biotech anytime they want, and they've seen the cycle happen, and it takes a long time. And I think the wilderness period, to go into and out of a wilderness period, we need to talk about the momentum and what brings momentum back to biotech, and is high level of M&A. It is, companies being successful in drugs and drug approvals. So, those sorts of things. It's difficult to raise money. The appetite is lower because only the generalists and have, by definition, the VCs have to defend their investments. There are few other investors who have the appetite.
And what drives that shift in the cycle? You're saying it's M&As and drug approvals that bring back investor appetite. Is it that when prices drop to below a certain threshold, and I know obviously this isn't a sort of a mechanical mechanism that we're discussing here, these are very complex, multiple actors operating in a very complex market, but is it a question of purely price, that the big pharmas can see that attractive assets are now much more cheaply priced than they were 12 or 18 months ago? Is that the issue?
Yeah, it is a combination, and you've hinted on something, an interoperability, if you like, between investors who could invest in biotech and big pharma companies, because M&A happens because big pharma and big biotech buy smaller companies, and they do that when they can see that what the smaller biotech companies offer them, they can't do themselves, or at least they can't do themselves for the same price. And many people have commented, and I would say we are in a wilderness period now, partly because of the overhang from the last biotech bubble. In that, you're a business development director at a big pharma company, and you want to invest in a ophthalmic medicine or a respiratory medicine. And you look around, and your internal pipeline is very early, going to cost you a couple of $100 million to get to a reasonable stage, even before you get into the late-stage clinical studies. But then your CEO says, okay, go find me a biotech. It does the same sort of thing, but it's more further on. And you find one, but it's still valued at $2 or $3 or $5 billion. That's not going to work for the board of a biotech company. As well as the momentum of M&A, which has some dependency on valuation, M&A transactions or external events like the Human Genome Project we talked about, or even the pandemic, and drug approval. So those companies who are still at early stage, getting their drugs approved and showing reasonable sales in early commercialization. All those aspects together, that momentum has to build for generalist buying investors, generalist biotech investors, or generalist investors to think, oh yeah, I haven't look at biotech for a few years. Let me look at that again. Oh, that's useful news. That's interesting. And hopefully there's more to come. So I'll take an aspect. I'll take a position on biotech.
But can we also characterize biotech as one single complete offering to the marketplace to investors? Or are there sort of within biotech itself different segments, different parts of it that are doing better than others? And that's a question of the individual progress that certain technologies make, or certain, focus on certain therapeutic indications can yield progress. There's obviously been a little bit of a sort of a pushback against AAV-based gene therapies, for example, for good reason in recent years, because of the sort of issues around safety and tox and cost that have not been resolved to people's satisfaction by and large. I mean, it's not to say that the approved therapies do not work. It's just that there's not enough therapies that have really moved the needle. For example, there's a big bubble in the whole world of radiopharma filing in There's a great expectation that drugs will sort of deliver because they're operating in kind of de-risked environments, or at least the people who are developing these drugs think that a lot is being de-risked and they're just going to add potency to the whole mix and that they've sorted out the manufacturing. So if you're talking about biotech, could you not say, well, there's really, 12 sub-segments and that different ones will be at different stages in the investment cycle? And that will play to the strengths of some companies who are maybe have an interesting offering in a segment that's doing well. It'll be difficult for new firms to go into a segment that's doing badly. How much of that has to be sort of taken into account as well?
I think it all, not to do an investor's job down, all has to be taken into account. They have to be jack of all therapeutic trades. If you're a biotech investor, then 1 minute you're seeing a company with a cell therapy, and 1 minute you're talking about a monoclonal antibody with another company. So, but within that therapeutic melee, if you like, we are at prime time for monoclonal antibodies and recombinant proteins. They are generally accepted as the basis to addressing druggable targets. We're probably getting to prime time on siRNA and RNAi. By contrast, we're living down the hype, as you say, of not just AAV, but lentiviral and other gene therapies that were supposed to be the one-shot drugs that cured patients, and there's tox, and there's durability problems, and do we really want to pay that amount of money when we don't know about the durability of the tox? So, there are reimbursement issues as well on CAR Ts and other cellular therapies, and then also gene therapies as well. So another reason why we're in that wilderness period is because people haven't quite made up their minds, and people meaning not just investors, but payers, about the payoff and the durability and the toxicology of those gene therapies and cellular therapies that got us to that level of the last peak, and that perhaps more hot air needs to come out of expectations of those, and it may come from commercialization of expectations. It's not as high as they thought it was going to be before we get down to other levels. And yet we saw only recently this week, and again, the 270 issue, they've got a CAR T therapy with Bristol Myers that's doing not very well, whereas the Gilead's CAR T therapy is doing wonderfully. So again, the old adage of it's not a one product market. When you have two competitors in a small molecule drug, depending on the toxicology, the administration, the convenience, and the safety and the efficacy, one will rise above another. And we're seeing that now, even in these most advanced therapies. So those aspects, the fact that you're being a biotech investor means you have to understand small molecules, you have to understand large molecules, you have to understand cells. If you might even have a foray into manufacturing monoclonal antibodies or cells or something. So you have to be a jack of all trades, because there is so much therapeutic diversity in the biotech sector, which is a good thing, right? I mean, compared to 20 years ago when I was still in pharma, or not 30 years ago when I was still in pharma, I thought we were doing cutting edge stuff and biotech was just playing around. Well, nowadays, pharma goes to biotech for cutting edge stuff.
And when you talk about investment bubbles and the companies not living up to the hype and all of that, at the same time, if you look at it from terms of what the companies have done, I mean, it's not as if that cash has been burned. I mean, it has maybe been burned in the metaphorical sense, but that cash has been invested in programs that have delivered data, preclinical or clinical data, that may or may not have value, obviously, and the quality of the data will determine whether or not the program will attract more investment. But can you not argue that, okay, from an investment point of view, it might yield a return for the investor, but in the long run, looking at it from the point of view of a global scientific understanding, if the data become available and are shared in a kind of a responsible manner, that ultimately is actually all part of the process of the development of biotech and the development of deep, deep bases of evidence that will guide future and medical endeavors.
Yeah, in a number of ways, I agree with you, Cormac, and in another way, I disagree with it. Let's do the agreement aspect first. When I was a bench scientist all those decades ago, my boss at the time told me, whenever you do an experiment, make sure you take something away from it. And then he added, even if let's never do that bloody experiment again. So yeah, you're right. Investors give you money as a biotech company. You invest something in experiments, whether it's lab based or animals or even clinical studies, and you come up with a result. It might not be the result you want, but that's still holistically part of the larger learning experience for humanity. And many companies will file patents on those and capitalize their R&D spend less these days than it is before, but capitalize their R&D spend on their balance sheet. So it's not been flushed down the toilet. It's contributed to the knowledge of humanity and everything. But there are other aspects, and this is why we're in the wilderness period, where all that investment and all those patent filings have not resulted in things that they were supposed to do, and that's let investors down. The other aspect is, and it comes back to our cyclical discussion, is that private companies are funded by VCs. And VCs have separate investing cycles. So VCs need to raise money, and they need to raise money by showing that their last fund or their last couple of funds returned a good return, a positive return, a significant return, rather than just didn't do anything. So you're a VC, you've invested in the company, you expect that company to make progress and that progress to be reflected in a valuation. And if we're in the private market, yes, it is, because other new investors come in and they fund that company at a higher valuation than you previously invested. And that's great for you. Like, you might have to support some of that investment by investing yourself, but also your existing investment gets rated at a higher level. One of the other ways of doing that is to IPO that company on the public markets, where you get an even higher valuation and you can sell your shares. But as we've talked about earlier, that's not really happening at the moment. And if it is happening, the VC investors have to put money in to do that. And that's not going to give them the returns. Certainly, Acelyrin's most recent IPO came to the market with an IL-17 inhibitor with a great blush of this is going to change the IPO market. And it failed within the first stumbling few months. That's going to put a downer on not just other IPOs that come after it, but just think of those VC investors who put money into that Acelyrin IPO and the public market investors who put money into that IPO are now thinking, oh, no, I was wrong there. I'm never going to do biotech again, or at least I'm not going to come back to biotech until the dust has cleared. So again, that doesn't help the wilderness period.
So the wilderness years are upon us. That's a rather grim prognostication.
It is, but
they're lasting longer than 40 days and 40 nights. And
but the important thing to remember, Cormac, is that it will end, right? I have no idea when it's end, and the best forecast in the world will not mortgage their house on the basis of knowing when that wilderness period is going to end. And you can only really tell when it's going to come. And when the NPI, the Nasdaq Biotech Index, has gone up 10 or 20%, some people might say that's too late. Some people will also say, contrary, that the investments you do today in the wilderness period, where valuations are lower, perhaps not today, but next year or a few months after, the investments you do in the wilderness period will be amongst your best returns. Because when
it's a contrarian investment style. It's crazy buying into the top. I've anecdotally heard people buying at the top and they're nursing losses of 40%, which is pretty grim. Okay, so I think we've learned today that things are seasonal. Well, we know that things are seasonal, but they're also cyclical. We can understand the cycling of a season, but we can't understand the cycling of a cycle, as it were. They're multi-year, multifactorial, and in a sense, it's impossible to know where you are in an investment cycle at any given moment. So you could argue that, fine, it's tricky for investors. It's also tricky for biotech executives, the people who are seeking that cash. And that just happens to be a part and parcel of the necessary dance between investors and investees that constitutes this industry. And that's not going to change, is it?
No. And in a sense, I almost want to apologize to listeners to say that we wanted to talk to you about some really important stuff, and all we told you is we don't know when the wilderness period is going to end. At least we've identified that period.
I think, though, it has to be said that all you can offer, if this doesn't sound too ludicrous, is that you have to keep dancing even when the lights are low.
Yeah.
That doesn't sound really appropriate, actually. There's a famous line from Heaney, but he talks about the tribe whose dances never fail because they keep dancing until they sight the deer.
Yeah. And this is why we have biotech specialists, right? Because they have to invest in biotech sector and offer those investments to their investors, come fair weather or foul, in the hope that, as I was saying earlier, you keep the faith, you make investments at the low point, and you will be surprised at how much they go up when the market goes ahead.
I think that's a suitably optimistic note to end it on. So for myself, Cormac Sheridan, our listeners, keep the faith. Thank you, Andy.
Cheers, Cormac.
Till the next time.